Hi students, good evening. Yesterday we have discussed some of the basic concepts regarding the recording of financial transactions. So we will also continue the same concept. Today we have just categorized the transaction into the main four things, and then again we have three things. The main first four things are related to the purchases, the sales, fixed assets and the investment, and then we have receipts of the cash, the bank related transaction and the expenses. So all these are like almost 7 total number of the transactions are there, or we can say these are the categories of the transaction. The same rule of the debit and credit we have just here, and then we have a journal with the date, particulars, ledger folio, debit and credit. So today we will discuss some of the basic transactions, or we can say like a categories of the transaction. So almost you can say like an 80 or 90% transaction fall between these 7 type of the transaction. So the first transaction that we are going to discuss is the concept of the capital investment and the drawing. Now with respect to the capital, we have two options. Either we have an investment or it may be a drawing. So we can say this is for transaction number 1 and this is transaction number 2. So for the investment purposes, there are two things normally: the cash or bank is there, these are increasing, and then the capital is also increasing. So as we have discussed earlier, that the cash and bank both are what? Both are the assets. So asset is increasing, then we have a capital. Capital is also increasing. Capital of the business is increasing, and also the cash or the asset of the business is increasing. So here we have a rules. I hope you remember that the cash is asset and this is obviously the capital. So asset is increasing and capital is increasing. So asset increase is debit and capital increase is what? That is the credit. So we have now transaction. For example, the amount is $3,000. So transaction will be recorded here. Let's say we say this is date 1. Now the capital account and the cash account. So the cash account as an asset will be debit. Let's say 101, and then we have a capital account 3,000. Let's say it's 102, and the basic simple description is there: invested capital, and this narration is just according to the person who is writing this transaction. So it is just for the explanation purposes. So now this is the basic transaction. So if there is not a cash, if it is a bank, so we will just replace this cash with the bank. So it can be a bank investment, like the person who is the owner has started the business with an investment in the bank, or the person has just in the form of the cash. So cash account or bank account will be debit and the capital account will be credit. Now the second transaction, that is related to the drawing. So we have to just go through the concept of the drawing. Drawing is what a person is invested in the money in the business. Now why he or she has invested? Because they want to earn the profit. Why they want to earn the profit? Because they want to run their daily expenses, their personal expenses. So after some time, after 1 month, 2 months, 3 months, when the business is started and they're growing, now what they will do, they will just use some of the money from the business for the personal use as their personal expenses. So they can get something out of the business. So that is called as the drawing. So here it is just reverse of the investment. So in the investment, cash account is debit or the bank account is debit and capital account is credit. But here what will happen, the cash account is decreasing and the capital account is also decreasing. So we can say the drawing is increasing. So drawing is just like the decrease in the capital, so that will be debit. So here, for example, the person has withdrawn $200 from the business as a personal use. So here we can say like that, drawing account debit and cash or bank account is credit for $200. This is what drawing by owner. We can also write here the capital account as a debit because the capital is decreasing, but just to differentiate later on when we will prepare the financial statement. So we want to know that how much was initially injected or invested in the business and how much was used by the owner later on. So that's why we can, just for the differentiation purposes, we are using another account, the drawing account. Otherwise, even we can use the capital account here. Okay. Now, the next transaction is related to the purchase of the fixed asset. Okay. So, assets, and in the assets we are talking about fixed assets. Now, what can be the fixed asset? There are so many categories are there. Normally we take the basic thing. The rule is like that: anything which is in the control of the business, which has some value and its life or its convertibility into the cash is more than 1 year, that is called as the fixed asset. So we can say like land, or it can be building, or furniture, it can be vehicle, it can be any equipment or machine, okay, or it can be any tools. So all these things will fall into the category of the fixed asset. For example, in the room, a businessman need the fan, they need the AC, they need the heater, okay, so that will come under the fixed asset. For example, they need the land, they need the building, they need the furniture, they need the equipment, they need the machinery. So all these things, or even the tools are there, the vehicles, the trucks or the cars, so all these will come under the category of the fixed asset. Now, fixed asset can be purchased by cash or on credit. By cash mean what? That you are buying a land, let's say for $10,000, you are buying a land and you are paying the cash immediately. The other option is that you are not paying immediately, but you are promising that you will pay after 1 month, 2 months. So that will be what? It will be credit. So we just say like the business has started, and let's say just for the understanding purposes that they are purchasing some of the tools for $300, where the life of the tool is more than 1 year. It may be used for 2 years, 3 years, 4 years. So they have purchased these tools for the business purposes, $300, and they are paying cash or they are paying on the credit basis. Now, the tool, as we said, is the asset, and the asset increases what? That is the debit one. Okay. Now, if they are paying a cash, cash is again the asset, and the asset decreases credit. Other option is that they are not paying immediately, they are paying after some time, so it will be considered as the credit transaction. So they have to pay it. It will be payable. Payable means that is the liability, and the liability increases credit. So we have two things, that asset is there, asset is increasing, tool is increasing, and the cash is decreasing or the credit is decreasing. So we can write here like, for example, this is the transaction on date 3 that they have purchased is the tools account, debit, that will be for $300, and then we have a cash account, or we have a account payable. Account payable means what? That is the liability, it will be $300. So purchased tools for business. So we have discussed two transactions, like a purchase of the asset, and then we have like investment and the drawing. So these are the main categories are there for the transaction. So the next thing that we are going to start is what is the concept of the purchases of goods, and then there are some return of the goods. Now, number 3 transaction is there related to the purchases of goods and the return. Now, the goods, we should understand the concept of the goods, or we should understand the concept of the purchases, or we should understand the concept of the stock, or also called as the inventory. These are the terms interchangeably can be used. So the purchases, stock, inventory, goods, that is the same thing. So anything the business is purchasing, and the purpose is what, that they have to resell it, like immediately they will resell it, or they may process it, they make up some finished goods from that and they will sell it. So that will be called as the goods or the purchases. Now it can be on the cash basis, or it can be on the credit basis. Means here the cash will decrease, here the credit will increase, and the purchases account will increase. So the goods are coming in the business, so the goods will increase, so that will be a debit thing. Then if they are paying a cash, so the cash will reduce, it will be on the credit side. Otherwise, if the liability, means credit is what, that is the payable. So this is what, this is the asset, and this is the payable, or what we say the liability. This is also credit, and the purchases will be considered as the debit. So the purchases or the goods are debit, and the cash or the payable, the liability will be credit. So here we will write the name of the supplier, like A, B, C, X, Y, Z, whatsoever the name of the supplier. So we will write with that. So for example, company has purchased the goods of $1,300. It may be purchased on the cash basis, or may be purchased on the credit basis. Let's say we will do it for the cash basis first. So the transaction will be same, just the goods account or purchases account will be debit, and cash account will be credit. So this is the transaction number. We can say transaction number 4. We can say purchased goods, and the amount is $1,300. So this is transaction is completed, that the company has purchased the goods and purchased goods on cash. For example, they have purchased some other goods for $250, but they are purchased on the credit basis, means they are not immediately paying. Let's say this transaction happened on the date number 5, on the 5th of January, February, whatsoever is the month the transaction happened. So they have purchased $250 goods for the resale purposes. So it will be the same transaction. Here the goods are there, so goods will be debit, goods account or purchases account, and then the account payable or credit, like whatsoever is the name of the supplier, the ABC, XYZ, whatsoever is the name of the supplier, so that will be credit. So the narration will be purchased goods on credit, like a $250. Now if you see here, both transactions are related to the purchases of the goods. So here in both transactions, the debit is what, that is the goods account or the purchases account. Okay, but only difference is what, here they have paid the cash immediately, so the cash is credit $1,300. And if they are not paying the cash immediately, they are paying later on, like after 10 days, 15 days on the credit basis. So the goods will be again here debit, but the account payable or the creditors will be on the credit side, that is the liability. And we have to mention the name of the supplier, the person from whom they are getting the goods on credit. So that will be the next transaction. Now there is a possibility that sometimes the returns are there. Return in what, that you are buying the goods as a business, and what happened, there is some quality issues there. The goods are like some faulty goods are there, or they may be not according to your requirements, so you may return the good to the supplier. So in that case the transaction will be simply opposite. So we say, let's say from that 1,300 they have returned $150 goods to the supplier, and they have, as you have paid already immediately cash, so they are receiving the cash immediately. So in that case, if there is a return of $150, so what is happening, the goods are decreasing, and what, the cash is increasing, because you have paid the cash, now you have returned the goods, now they are giving back the cash to you and you are giving back the goods to them. So transaction will be just reverse. The goods account will be decreased, so it will be credit, and the cash is increasing, so that will be debit. So we can say it's a return transaction on the 6th of the month. So here we can say like a cash account and purchases or goods account. And then we will write the amount. So it is what? It is $150. Goods are returned. So we will write here return goods. The transaction is complete. So it means we have discussed almost 3 main type of the transactions related to the capital, investment, or maybe drawing. Then the purchase of the fixed asset, and then the purchase of the goods and the return. So here, just for the revision purposes, if there is any investment, so the cash account or the bank account will be debit and the capital is credit. And when you are taking money as a businessman from the business for the personal use, so the drawing account will be debit and the cash account will be credit. Here cash is increasing, here cash is decreasing. The next transaction is related to the fixed assets. So it may be a land, it may be a building, it may be vehicle, any tool, equipment, computer, anything which has a life of more than 1 year, and this for the business use, not for the resale purpose. So that specific account will be debit, and the cash account, or if you are not paying immediately, the account payable will be credit. Payable for the tools, payable for the land, so whatsoever, so it is a liability, so it will be credit. Then the next transactions was related to the goods purchases. The purchases mean those things which are purchased for the resale purposes or for the business, like a reproduction purposes, so that's as purchases. Now it will be like a debit, and then it will be a credit. So what will be debit? Purchases account will be debit, and the cash account, because you are paying the cash, it will be credit. If you are not paying immediately, same, goods will be debit, but the payable will be credit. And then sometime it happens that you have to return the goods, so that cash will be debit, and account that you have purchased, the purchases account or the goods account will be credit. There's a possibility sometime that you have returned the goods, but you are not receiving the money immediately. So in that case, there is a possibility of the account receivable, that the amount you will receive in the future, but you have returned the goods. So these are the first 3 main categories of the transactions we have completed up till now. The next transaction that we have is related to the sale of the goods and then the return of the goods. So the sales mean that is related to the revenue. Now what is the revenue? Basically the goods we have purchased for the reselling purposes, you are selling those goods. Okay, now here we have 2 options. The sales can be on the cash basis, or it can be on the credit basis. So if the sale is on the cash basis, so what will be the effect? That immediately you are receiving the cash, so the cash is increasing. But if it is not on the cash basis, it is on the credit basis, so it means that the credit means what? That is the account receivable is increasing. Account receivable is also called as the current asset or simply the asset. So the cash is also asset and account receivable is also asset. So in both cases the assets are increasing. This is the first effect. So we can say like this is the transaction number 7 and this is transaction number 8. Now let's say we $390 on the cash basis sale is there, or on the credit basis like we say $195 sale is there. Now one side is okay that we have received the cash immediately, or there is a promise that they will pay after 5 days, 10 days, 15 days, so that will be the receivables. So this is also asset. So asset, if you remember, the asset increase is debit. So here it is debit, here it is also debit. The other thing is what? That is the sales. The sales means that is the revenue of the business, and the revenue of the business, if it increases, that is the credit. So the sales or revenue will be credit. So now we have a debit side and we have a credit side. So first we will record the transaction number 7. The goods are sold on the cash basis and the cash they have received immediately. So that will be a cash debit, and the sales account or the revenue account will be credit. So here we can write the cash account and sales account. So the amount is how much? That is $390. So we can write the duration as the sold goods on cash. Now the next transaction is what? Again there is a sale. It is a revenue, but it is not received immediately. They will pay after, let's say, after 10 days, 15 days, 20 days. So there is some credit transaction is there. So it is a receivable or account receivable for the business, or what we say in the accounting term as the debtor. So here we will write not the cash but the account receivable, or we say it is a debtor. Here we have to mention that who is the customer, from whom we have to receive the money, just for the record purposes, because there are so many customers are there. So you should have a record or the account of every customer separately. So we say, let's say it is for the X, Y, Z, and again the sales account will be credit. The amount is how much? That is $195. So this is also sale. So sold goods on credit. So here if you see in both transaction number 7 and transaction number 8, in both transactions the sales is increasing, the revenue is increasing, and the revenue increase, as in the debit credit rule we have the revenue increase is what? That is the credit. But in the first transaction, cash, immediately cash business is receiving, so the cash is asset, that is receiving, that is a increasing, that is debit. Otherwise, if they are not receiving the cash immediately, they are receiving a promise that they will pay, the customer will pay after 5, 10, 15 days according to the credit terms. So that means that the account receivable or the debtors will be credit. But in both cases, the sale is credit. Now there is a possibility of sales return. Now sales return means what? At some time the goods you are selling have some issues. It may be some quality issues, or they are not according to the specifications of the customer. So what they will do, they will return the goods. So in that case, just the transaction will be reversed. Let's say it's a transaction number 9. For $30 they have returned the goods. In that case, what will happen? You have to received the goods, because those goods you have sold to the customers, now they are coming back to you, so your revenue is decreasing. So the revenue decrease means what? The revenue decrease is debit, so that is the sales return, that will be debit. Now there's a possibility that you are paying the cash immediately, or sometimes there's not possibility that you have not received the amount from the customer. So let's say in that case, if there is a sale return transaction number 9, so the sale return account, like a $30 is debit, and then the cash account. Why the cash account? Because if you are returning the amount to the customer, why you are returning the amount to the customer? Because they have returned the goods to you as a business, so now you have to pay the amount to the customer, so that's why there is a cash account. There is a possibility also that this person XYZ, who was your customer, has returned the goods. In that case, what will happen? Instead of cash, there is a possibility that it was an account receivable, so account receivable, or the debtor, who is XYZ, will be credit. So there is a possibility that the customer who has not yet paid is returning the goods, so it is a sale return for you, it is a revenue decrease for you. At the same time, your receivables, your asset is also decreasing, so it is just like a reverse entry for that. So we have a $30 return is there, $390 was the sales, $195 was the sale. Both were sales, but one sale on the cash basis, one sales on the credit basis. So the cash basis sales we have recorded here, sales debit, cash, we have a sales credit, and the cash is debit. If it is not on the cash basis, it is on the credit basis, then account receivable, the debtors, means the customer name XYZ is debit and the sale account is credit. Now if there is any return, the customer has returned the goods to us, so instead of the increase in the sales credit, we are decreasing the sale, the revenue is decreasing, so that will be debit. Here sale increase, it is credit. Here sale decrease, it is debit. So sale return we are just writing to differentiate. We want to know that how much the goods are returned for the analysis purposes. For example, company has a sales of $10,000, $20,000. Later on, at the end of the year, they want to know that how many goods the customers have returned. They want to know the reason. So that's why they may write it as a separate account, as a sales return. This is just the reverse entry for those. Now, the next thing that we have is related to the expenses account. We can say it's like a transaction number 10. So any amount, let's say we say $235. Now, what is the expense? See, the goods we have purchased because we want to sell them. Okay, selling the goods is there, but other than that cost, there are so many things that the company or the business or the businessman has to pay to run the business. For example, the very basic thing is the rent. If it is not your own shop, it is not your own factory, you have to pay the rent. What else you have to pay? You have to pay the salary. Okay, you have to pay the insurance. You have to pay for the advertisement. You have to pay for the electricity, the gas, any fuel, any repair. So whatsoever are the expenses, so that will be amount that the company has to pay to run the business. It may be for the telephone. There are so many expenses. Obviously, the list is not complete, it's not a comprehensive list. So many expenses are there. Repair is there, stationery is there, advertisement is there. So many expenses are there. So the company has paid some of the expense. We just take it as a rent expense, salary, insurance, advertisement, electricity, gas, fuel, repair, telephone, or anything else. So $235 they have paid. Now this is the expense. And if they're paying the expense, it means what is the next thing? If it is expense, it is increasing, and expense increase is debit. And what is decreasing? The cash. Because if you are paying the expense, you are paying the rent, the cash will decrease. You are paying the electricity bill, the cash will decrease. So the cash is what? The cash is asset, and the asset decrease is what? That is the credit. So these are the same transaction. It may be for 1, 2, 3, 10 type of the expenses are there, but the nature of the transaction will be same. So we say like a number 10 transaction. This is, for example, rent expense debit, and then we have a cash account. Okay, so how much? $235. Paid rent expense. How if it is salary, transaction will be same. If it is insurance, transaction will be same. Only the amount will be different. The transaction debit will be different. The account name will be different. Otherwise, transaction nature is same. Always is a cash. Sometimes some of the business are not paying the amount in the form of the cash. They are paying through the bank. How they are paying to the bank means there are some possibilities that the companies have a bank account and they are paying most of the transaction, most of the expenses to the bank. In that case, instead of the cash account, we can write like a bank account. They are not paying the cash in hand, but they are paying to the check or to the bank transfer. So here the same thing will be, it is asset is decreasing, asset decreases credit. So any expense that the company is paying in the form of the cash or in the form of the bank, that expense will be debit. Repair expense, debit, cash, credit. Repair expense, debit, bank account, credit. So whatsoever expense, they are paying the electricity bill, they are paying the gas bill, they are paying for the fuel, they are paying for the telephone, for the advertisement. So that expense will be debit, and then the cash or the bank account, whatsoever is the nature of the transaction, according to that, the payment will be credit. So debit and credit, and then we will write a simple narration for that. The next transaction that we have is related to the cash receipt and the payment, or what we say, sometimes the company is receiving the cash. What are the main source of the receipt of the cash? We have already discussed, that was the sale of the goods. But there is some other possibility that the company is receiving the cash. So what are the possibilities of the cash receipt? One main option that the company is receiving the cash is through the capital, that some owner is investing in the business, so in the form of the cash, some sale of the goods, so they are receiving the cash from the customer. Some of the debtors, like the person who has to pay the money to the business because they have purchased the goods but they have not paid immediately, so they pay the cash to the business. So in that case, there is a possibility that the company or the business is receiving the cash from the customer. So in that case, the cash receipt, the cash will be debit because the cash is increasing, and because it is an asset and the asset increases, debit. Okay. Now, what is the second thing? For example, business is receiving cash of $215. Now we have to see why business is receiving the cash. If it is due to the capital, cash debit, capital account credit. Okay, so capital will be credit. Otherwise, if it is due to the sales, it is due to the revenue, so sale is credit. Or there is possibility like other income. What may be the other income? For example, the business has a main source of the income. They are selling like some bookstore they have, but sometimes they have some scrap material is there and they're selling it for $5, $10, $15. So this is also the income, but this is not the main source. So we cannot call it as a sale. It will be considered as the other income. So any amount which they are receiving from that amount, so that will be considered as what? As the other income. So one main source is there, that is the sales. But other than the sales, there are some other sources, like they have some rental income is there, they have some interest income is there, sometimes they are selling the scrap sales. So whatsoever they are receiving, so that will be credit, and the cash account will be debit. So we can write like a transaction number 11. Anything we can write like they are receiving the rent income of $215. So the cash account debit $215, and rent income is credit $215. So what we will write? Received rent. Okay. So here we have a transaction. Then there is possibility of the payments. Again, what is the possibility of the payment? Why we are paying the cash? You remember we have discussed about the drawing. The owner is using the cash of the business for the personal use. So business is paying the cash, so the cash will be credit. You are purchasing the fixed asset, you are receiving the fixed asset, land, building, furniture, and you are paying the cash, so cash will be credit. Okay, then you are purchasing the goods, you are paying the cash. You are not purchasing the goods on the cash, but after some time, after 10, 15, 20 days, you have to pay to the suppliers who are the creditors or the payables. So it means that will be the cash payment. Okay, you have took the expenses, all the expenses you are paying, most expenses, 90% expenses on the cash basis, so you are paying the cash. So all these reasons why you are paying the cash. So for the payment purpose, okay, so what will happen? The cash will reduce, it will be credit. Now we have to write the reason that why the debit, because it may be a drawing, okay, it may be a fixed asset purchase, okay, it may be goods purchase, okay, it may be any expenses payment. Okay, so for all these things the business has to pay the cash, so cash will be credit, and anything like a drawing will be debit, fixed asset will be debit, or the goods you are purchasing will be debit, or your account payable will be debit, or you have taken a loan from the bank and now you are paying it back, okay, like a bank loan, so that will be debit. Let's say they are paying $500 as a bank loan, that is the transaction number, we say number 12, that was 11, so this is the number 12. So they are paying the cash which they have took a loan from the bank. So number 12, bank loan will be debit, bank loan payable. It was a liability. Now the liability, if it is reducing, it is decreasing, so it will be debit. So how much they are paying? They are paying $500, and then the cash account will be credited by $500. So paid loan. So they have paid the loan to the bank. So all these things, drawing is debit instead of bank loan. If the owner is using the money, if it is a purchase of fixed asset will be debit, cash credit. If it is a good purchase, goods will be debit, cash credit. If it is expenses, so any expense, rent, advertisement, that will be debit, cash will be credit. You are paying to the suppliers, so account payable will be debit and the cash will be credit. You are paying the bank loan will be debit and the cash will be credit. So these are the two transactions related to the cash receipt and the cash payment. So any amount which you are receiving, cash will be debit. Any amount which you are paying, the cash will be credit. Only the reason you have to write the other thing, which is other account that is affected. It may be a liability, it may be asset, capital, or the revenue. So what these are the main things that you have to record. And the next transaction is related to the bank transaction. Now the A bank transaction, it may be a deposit or it may be a withdrawal. Now, most of the transactions nowadays are based on the bank. The companies or the businesses are not using the cash because it is a bit risky also, and maintaining the cash, a large amount of the cash in the offices are different and difficult for them. So that's why what they do, that they transact through the bank. They deposit the bank amount or they withdraw the amount from the bank. So in that case, the transaction, so we have two things. One is the cash in hand and the other is cash at bank. So this is called simply as a cash account and this is called as the bank account. There is a possibility that the business has more than one account in the bank. So bank A, bank B, bank C. So they have to maintain the account for every bank separately. They have to mention the name of the bank, that this is the bank A or bank B or bank C, whatsoever is the name of the bank. Now, whenever we write a cash, it means it's a hard cash, the physical cash that is available. When they write a bank, it means the amount that is invested or that is deposited into the bank. Now, the bank amount that is invested or deposited may be for the safe purposes, for the safety purposes, or just they want to get some of the interest from that. So now we will discuss two main transactions regarding the deposit into the bank and the withdrawal from the bank. Let's say they have deposited $360 into the bank account. Now, the bank account is the asset and the asset is increasing and the asset increase is always a debit. Now, what they are depositing, they have a cash with them, cash in hand. Now, the cash is also asset and it is decreasing, so it will be credit. So, one effect is what? On the cash, other effect on the bank. So, we can say like this is a transaction number 12, that they have deposited the money into the bank account. So, the bank account will be debit and the cash is reducing, the cash in hand is reducing, so that will be credit. So we can say like a number 12, cash account, and sorry, that is the bank account, and then we have a cash account, that is deposit in bank. How much deposited? That they have deposited $360. So the amount which they have deposited, that is $360, that is deposited into the bank. Now the other transaction, it is a reverse. What they are doing, they are withdrawing the money from the bank for the petty cash purposes, because sometimes you are unable to pay through the bank, so you have a small payment, the petty cash payment, so you need some cash in the office also. So let's say they have withdrawn $50 from the bank for the business use, for the petty cash purposes. So now again, what will happen? The bank account is reducing and the cash account is increasing. So just opposite entry will be there. They have withdrawn $50 from the bank. So what will happen? The cash account means cash in hand, that will increase by $50, and the bank account means the money in the bank, that will reduce by $50. So it is withdrawal from bank. It is just opposite transaction. If you are investing the money, you are depositing the money into the bank. So why we are using the word investing? Because sometimes the business has a extra cash available. So what they do, they just deposit the money in the bank for the investment purposes. Why investment? Because the bank may be giving them some of the interest to them. So in the same way, sometimes they are using the money for the office use, for the small cash needs, so petty cash, so they withdraw the money. So we have a bank account debit, cash account credit, or If the cash they are withdrawing, cash account will be debit, cash in hand will be debit, and the cash at bank will be credit. So these are just two opposite transaction or reverse transaction is there. As we said that there is some possibility like interest income, or there is a possibility of the bank charges. Interest income means sometime you have a money in the bank, and after 2 months, 3 months, 6 months, or according to the agreement, bank is giving you the interest because it is your investment. So the bank will give you some interest. Let's say bank is giving you $20 interest. Now what is happening? The amount in the bank is increasing. So how we will say, let's say it is a transaction number 14. The bank has credited the $20 amount into your account because your balance was there for the last 6 months and there's an interest calculation of $20. So they just credited $20 amount into your bank account. So here the bank account will be debit means your cash at bank will increase by $20. And what is the reason? Why? Because it is the interest bank is giving to you. So interest income. So $20 interest income is the credit. Okay. So interest credited by bank. Now number 15 transaction. Sometime bank is charging you some amount. Why? It may be interest. It may be ATM charges. It may be a checkbook charges. So let's say the bank is charging you $15. So for any reason. So that is the expense for the business. But what is happening? The money in the bank, the cash in bank is reducing. So we will charge like that, like interest expense. Okay. Or it may be bank charges. Account will be debit like a $15. And what is reducing? The money in the bank is reducing. Here it was increasing, here it is reducing. So the bank account will be credited by 15. So we will say like a bank charges debited. Means bank is reducing the money which you have deposited into the bank and they are deducting their charges like interest charges or the ATM charges or the checkbook charges. So all these amounts they are deducting from you. So here they are crediting the amount in your account. They are giving your income to you because your amount was in the saving account and after some time they are crediting the interest into your account. So here bank is increased. Your money in the bank is increased due to the income. And here the bank amount is reduced, your amount. You have not withdrawn but bank has deducted that amount due to any charge. So that will be credited. So these are the main 7 transactions that we have discussed today. I hope you have got some of the concept, and still if you have any doubt, if you have any question, you can ask me in the comments. Thank you very much.